Hey guys.
Howdy. It's
Hey, Ken.
always odd to be waiting for the final go, and when you've got that degree there, it's the moment before. I don't know.
DAT IQ live purgatory, if you will.
Yeah.
All right, I think we're just going to wait a few minutes to have YouTube catch up with us. I think we're having some trouble this morning. It must be all of the political ads running this morning, the last minute push, if you will.
Mm-hmm.
Yes. Have either of you actually read Purgatorio, the Dante's Purgatory book?
Yeah, I think I've read all three of them, right? There's Paradiso.
Yeah.
Sounds like you're wrestling over there, Dean.
Sorry. The microphone was falling off.
Yeah, Paradiso is super boring, though. I mean, I remember Purgatorio being okay, but I don't know.
A lot of trippy stuff in that one. People that,
Yeah. I guess it's hard to describe people like enjoying, like having a good time in more exciting detail than all those jerks suffering. I don't know.
For sure. I think we'll give it one more minute, and then if YouTube doesn't catch up, we will just be exclusive on LinkedIn this week. How's that sound?
Ooh. Bonus content for our more LinkedIn-y subscribers, I guess. I don't know.
So I think maybe now's a good time while we're waiting to get started to cover the election sausage rumor.
Really? Okay. All right. So I have heard that there is an Australian custom that on election day, free sausages are served at polling places. And I wanted our resident, at least former Australian, to comment on this rumor.
Yes, it's a true story. The sausage sizzle is quite famous in Australia. It's actually a fundraising event. So it happens at every polling booth. Parents and citizens, all sorts of different charitable organisations organise a sausage sizzle. So the renting and hiring of outdoor barbecue settings reach a peak on election day. It's a big fundraising event. It's been going on for years.
Boy, makes me a little. I mean, there's like a million different animals that can kill you down there, but if every 4 years you get sausages, I mean,
it's
kind of worth it, right?
It's a great day.
4 years, is it? It's they don't do fixed parliamentary terms. It's
correct.
Yeah. So it could be every 2 years, Ken. You could be getting free sausages on a very regular cadence.
I got to look for flights. Anyhow, we're going to get started. It turns out we are live on YouTube. So welcome, everyone. This is our DATIQ weekly market update. This is our update for November 3rd, which is election day in the United States of America. So if you haven't already, try to get out there best you can and vote. I have not voted yet. That is first order of business after we're done filming this. I'm joined by Ned Damon, who is our principal data scientist, Dean Croke, who is our principal industry analyst. And next week, we'll be calling the bullpen and bringing in Cynthia O'Rourke, Dr. Cynthia O'Rourke.
Cynthia O'Rourke, thank you, yes.
That's right. I preempted you, Ned, who will be filling in for Ned next week. Do you feel threatened at all, Ned?
No, I feel like it's important to sort of build up the accomplishments of other people. Like, people see my face all the time, and that's fine. But if you're going to bring in somebody else, I feel like it's really important to establish their credentials, establish their bona fides.
I mean, it couldn't get any worse of a betting track record. So
I disagree. I'm not sure if you've seen like my more extended betting track record, because my show betting track record is but a subset of my lifetime betting track record.
Oh, geez. We'll have to dig into that one in future episodes. So for those new to the show, we're here every week on Tuesday mornings going through all the ins and outs of the freight markets, looking at trends, data, and answering questions. So if you have any questions for us related to load board activity, rates, general freight trends, go ahead and drop it in the comment box or question box below, and we will get to those at the end of the show. We also have, each week, Dean puts out the written market update. That's at dat.com/market update. And if you have any longer form questions or something you can't think of right now, askiq@dat.com is a great way to get a hold of us. And with that, I'm going to jump into our key points for this week. So if it's November now, I mean, so we just came off the end of October, so end of the month, last week of the month typically brings with it higher volumes and an uptick in rates, which is what we saw. So total load post volume was up, and rates seemed like they wanted to start to inch up after essentially staying mostly flat for all of October. Truck postings for loads are down, and then a key external indicator that we look at is the U.S. Bank Quarterly Freight Payment Index. It's a mix of truckload and less than truckload, and that showed shipments down 7.6% year over year. I'm assuming that's an October stat, but it may be a September stat. Maybe Dean can clear that up for us, because I'm going to turn it over to him now for his market update.
Yep, thanks, Ken. That was the September update, so it was their quarterly update. It's a pretty good indicator. Kind of confirms a lot of the other indicators we've seen. So jumping into our market update on the supply and demand side, we'll start with the load to truck ratio in dry van. After 3 successive weeks, the dry van load to truck ratio reversed course. As Ken mentioned, shippers were clearing their docks with end of month volume, fairly normal procedure. The load to truck ratio increased 20% to 4.76 last week as a result of dry van load postings, which were also up 12% last week as a result of the end of month. Available capacity tightened, about 6% fewer trucks posting loads last week, taking advantage of the higher volumes. On the refrigerated side, the refrigerated load to truck ratio increased 28% to close to 10. After dropping steadily for the prior 5 weeks, reefer load posts increased by 14% last week. Available capacity in the reefer side also tightened, with 11% fewer trucks posting for loads. In the flatbed side, volumes increased less of the 3 equipment types, only moved up by 2%. Load to truck ratio for flatbed moved up to 36.42. And capacity tightened slightly, with 6% decrease in trucks posting for loads last week. Having a look at our market condition index this week, end of month volumes for our top 10 freight markets increased by 10% last week, led largely by the West Coast for the second week in succession. There's a big surge in imports. In fact, the JOC report record levels of imports from China. In the Ontario and Los Angeles markets, volumes increased by 27% and 20% week over week, respectively. Outbound rates also moved up 6 cents a mile last week to $3.09 out of Ontario and $3.02 out of Los Angeles. A little bit further north in San Francisco, import volumes forced up outbound loads by 20%, and further north in the Pacific Northwest in Seattle, it's a favourite of the Northern China imports, volume spiked 32% week over week. So a lot of volume this week driven largely by imports from China. Moving over to the refrigerated side, again, our focus is on the North Pacific Northwest. Capacity remains really tight. Spot rates moved up 7 cents a mile to $2.39 last week. Regionally, volumes in the PNW moved up 27% week over week. Last week, there was a shortage of trucks in the Twin Falls market for potatoes and onions, as volumes spiked 31% week over week. Rates also moved up 9 cents a mile to $2.53 out of Twin Falls. Further north in Pendleton, there was also a shortage of trucks for apples and pears. 26% week over week increase in volume out of that market. Rates are up to $2.37 a mile. And the big mover on the East Coast was in Charlotte, where volumes spiked 60% week over week, driven largely by sweet potatoes. And of course, this time of the year, turkey production. North Carolina, no surprise, is number one in both turkey and sweet potato production at the moment. On the flatbed side, overall load post volume in our top 10 markets increased by 2%. But notably, some of our larger markets showed decreases this week. The softwood lumber rich Portland and Medford markets saw a decrease of 5% and 30% week over week, respectively. That's significant. They are generally big outbound flatbed load markets. Rates were down 12 cents to about $2.54. In Alabama, it's our number one market in the southeast for flatbed loads. In particular, lumber volumes were down 20% week over week in Birmingham, Montgomery, and Decatur. And in Memphis, which is normally our number one market for flatbeds, it lost its number one place to Little Rock last week, where volumes jumped 24% week over week. In contrast, though, volumes are up also in Little Rock, and rates remained flat at $2.75 per mile. So wrapping up our weekly update with a quick look at our year-over-year spot rates. National average dry van rates inched slightly higher last week on strength of end-of-month volumes. Rates ended at $2.25 a mile, excluding fuel surcharge. This is, interestingly, it's up 50% year over year, and as you can see from the chart, we're still in record-setting territory for this time of the year. In the refrigerated side, rates had plateaued for the 4 weeks prior to last week. They moved up 4 cents a mile to 242 last week. Reefer rates are now 63 cents a mile higher than the same week in 2019. And for the first time in 2020, reefer rates are now 1 cent per mile higher than the previous record set in 2018, when capacity was the tightest it had been in a decade. And finally, on the flatbed side, flatbed spot rates ended up slightly last week, up a few cents, ending at 223. The rates are still up about 45 cents a mile on this time last year when they were $1.78 per mile. So that's it for this week's market update. You can learn more about our weekly freight market update if you go to DAT/resources and download the market update. So Ned, that's it for the weekly update. Over to you.
Wonderful. So, pardon. We're going to be going through our forecast model runs. So these are our short-term models, or short to mid-term models, I should say. We're going to start off with our dry van spot rates. In blue, you can see the market rates observed by DAT. And then off to the right, you can see our spaghetti. That's a couple of different models that we run. In green is our ratecast model, which is our flagship model. In red is the more short-term focused short-term model. And in between are the two blended forecasts that are mixtures of ratecast and short-term in different amounts and in different ways. So I think this, number one, there's a lot of model agreement, which I like. The second thing that I think is really interesting is that we have an inversion here, where normally the short-term model has been much more aggressive and bullish than the ratecast model has been, but now there's been a flip-flop where the short-term model is expecting a continued plateauing and a slight decrease, maybe on the order of a couple of cents going in through the start of December, whereas ratecast is expecting there to be that same flatness for the first couple of weeks of November, and then it to spike up as we move into later November, December. And here, assuming that normal seasonal patterns hold, I think that ratecast absolutely has the right idea.
Hey, Ned, just as a thought, I hate to interrupt your flow here, but
no, by all means.
When we started doing this, right, we started early March showing this view. It might be more helpful for folks if we kind of truncate the history to just a couple quarters, because I think the piece of feedback I received was it begins to mute some of the travel in the forecast when there's essentially 3/4 of a year of history or more.
Totally reasonable. Yeah, no, I'll start. I think July is probably a good point to truncate it. Maybe do like a rolling 6 months or something on that order.
Yeah. 2 quarters probably sounds fair. Yeah, let us know too in the chat or comments below if you'd prefer to see the longer term, or if you prefer kind of us to alternate each week. It's something we've been talking about internally. If do we show the long term or the short term forecast every week? Mm-hmm. Go ahead. Sorry to interrupt you.
Oh yeah, no worries. So moving forward to the reefer forecasts, again, you can see the market rates observed by DAT in blue, and then the ratecast in the short term and the two blended forecasts off to the right. Again, ratecast is green, short term is red, and the blended forecasts are mixtures of the two in different ways and in different amounts. Here, there's a little bit more model divergence. Again, you have that inversion where previously the ratecast model had been somewhat bearish and the short-term model had been somewhat bullish, but now the ratecast model is much more bullish. It's expecting that kind of normal seasonal hump as we head into late November, early December, falling off after Thanksgiving and Black Friday, whereas the short-term model is still bullish, but it's got less of that kind of pronounced seasonality to it. Finally, we're moving to flatbed. Again, the market rates observed by DAT are in blue, and the ratecast model is in green. The short-term model is in red, and the blended forecasts are in between. A lot of model agreement here. There's a little bit of disagreement about whether or not there's going to be a little bit of a dip, but overall, the trend is basically up and to the right very slowly for the next couple of weeks. And I think that covers our forecasting, and it's time to move on to the Ask IQ update of the week, which is what are we seeing going in the longer term contract market?
I think we have a visual. So this it's kind of morphed from a one-off request to a series, right? So we did spot rates for dry van. I think we covered spot rates for reefer last week. And now we're moving on to contract rates for dry van. So as soon as we get that visual up. So again, let me just make it larger because as I age, my eyes degrade. All right, so these are national dry van contract rates. So just to refresh everyone's memory, the blue line is actual and So this is only the longest haul shipments. So pay less attention to the absolute value and think more about the relative. The reason we only use the longest haul shipments is we want to eliminate as much price friction as possible. What's price friction? Shorter length of haul shipments don't typically respond as quickly to market dynamics as the longest haul shipments. So we want to find just the longest. This is only shipments 550 miles and above. The dark gray shaded area is the year-over-year comparison. And I have the dotted blue line is the base case out of Ratecast. The green line is the high projection, and the red line is the low projection. So this is 52 weeks of forecasts and about 5 years of history. So what you can see is we're capturing at least 3 to 4 months of upward travel in the actuals. And Ratecast in the base case is expecting that momentum to carry through and not really start to decelerate until spring of next year, late spring. The low case has that plateauing out a little bit sooner, kind of right at the start of the year, but still gaining a substantial amount of ground. This very much aligns with a lot of the public disclosures we've been reading from large shippers and publicly traded carriers that they expect low double-digit rate increases on the contract side. But I'm curious to see, Dean and Ned, how this aligns with what you've been seeing, what you've been hearing, and what you expect.
I mean, from my perspective, one of the things that makes contract rates, especially in relation to spot rates, kind of hard to model is like the physical model I like to think of is that they've got two things moving that are connected by string. So if one gets too far ahead, it'll kind of drag the other along. But it dragging the other guy along will tend to slow things down a little bit. And I feel like spot rates have been so high for so long that contract rates really are starting to get dragged up. And once contract rates start adjusting, there's a tendency for them to kind of keep adjusting. And so that this aligns very much, unsurprisingly for my model, this aligns very much with what I'm expecting.
Yeah.
Yeah, I tend to agree. I sort of always err on a little bit more cautious side, Ken. I just see some more downside risk to spot rates increasing as fast as they have. There's more downside than upside as I look at the demand side of things that carriers haul. I think there'll be winners and losers as we've seen for the last few months in terms of different market verticals will have high volumes, others will have low volumes. I was interested this week that Professor Kaplis wrote about the market returning more towards some form of normalcy. So I think the market has adapted to the new normal in terms of a bifurcated freight market. I suspect once we get past New Year, though, volumes will fall off and we'll start to see that upward pressure start to decrease, if that makes sense.
Yeah.
Yeah, here's one thing I'm struggling with, and I'll kind of say this and then wait for a response. I don't think both things can be true. I don't think we can see both the extreme bullish forecast that kind of some of us are anticipating for spot rates as well as contract rates. Because I think if we do see 15 to 20% year-over-year comps in contract, that will necessarily pull a ton of capacity and freight over back to the contract market, and the spot market will likely kind of regress back to let's say it gains 5 to 7% of ground from 2019. I mean, does that make sense? Does that run contrary to how you guys are thinking about it?
I mean, again, to use that kind of two blocks on a string analogy, if one block is going high, then it's going to tend to pull the other block along. And as it pulls the other block along, it's going to tend to slow the first block, where some of that momentum is getting bled out into moving the trailing block. I don't know. I do think that there's a lot more downside risk on spot rates, and I do think that especially if contract rates start adjusting, there's that kind of feedback effect where as contract rates start adjusting upwards, more people are going to be willing to carry more volume on the contract market, and that will put a downward pressure on spot rates. But that kind of interaction is really tricky to model properly.
Yeah, it is. And I don't mean to jump ahead of you, Dean, but that's a problem I always struggled with, because I think in the short term, spot rates lead contract rates, the movement. But then long-term contract rates lead long-term spot rate outlook, right? Because if contract rates go up 10%, you almost necessarily see spot rates come down because a lot of that demand shifts back into the contract market.
I mean, the other side of this is the supply side, Ken. We talked about it this week, where this is the time of year you typically see a capacity migration where carriers in the the lowboy, flatbed, drop deck specialized, dump trailer swap out their trailers for dry vans to haul stage equipment around for shows. But that's not happening this year. If it's a bad winter, we don't have a lot of snow and salt to haul. So there's a lot of capacity that could drop their traditional trailers and jump under dry vans and bring more capacity into that space where there's a lot of demand. So I think that's going to be the big unknown. Weather plays a big role in where capacity moves regionally, especially in the northern latitudes. So I think that's going to be something to watch as we get past Christmas.
Yeah, I'm kind of firmly in the camp, and maybe we can manifest this into another wager, but I'm firmly in the camp that 2021 will largely be dominated on the demand side. Mm-hmm. I mean, I think capacity will have an effect, but I think the overwhelming steering currents, if you will come, right? Because there's so many big unknowns, right? What's going to happen with the industrial economy?
Right.
Are we going to see food service? Are we still going to be locked down in March and April, or are we going to be going on spring break and going back to the tiki bars? Mm-hmm. Mounting credit card debt, lack of stimulus, are people still buying Amazon and Wish.com type stuff? I think a lot of those things are unknown, and it's much more prevalent on the demand side. Mm-hmm. Mm-hmm. But it'll be interesting to see kind of how that all shakes out.
Yep.
Yeah, no, I think that there is a lot of opacity, especially when we're starting to get into mid to late Q1 2021. And
yeah. So it looks like we got some feedback. Give a shout out to Tom at Kingsgate. He suggested tighten up the history. I agree. I think he's suggesting 3 months. We have some other folks suggesting a couple quarters. I think we might split the difference there and see how it looks for next week. And then we have also some votes for long term. So we might do like an every other week approach, and then maybe Dean, we can add both into the written update. We have a lot more space there that we can consume, if you will.
Right.
Yeah.
There's a question from Chris Gonzalez. This is more just a vote for long-term rates. He mentions a couple of things about freight balances long-term, increase and decrease in imports and rail. It's interesting, right? The Pacific Northwest hasn't been that, especially like the extreme, like Puget Sound and that kind of area. But as soon as Union Pacific announced the $1,000 upcharge, we saw rates and volume spike, and then MCI as well. So
right. And then volume surged into just north of that in Vancouver and Prince Rupert, where of course they run on-dock rail straight to Chicago every day.
Yeah, I've been wondering. I don't have, and we may have it. I just may be ignorant to it even a year into this gig. If we have, because that was a huge thing when I was in industry, that bypass where you just don't even deal with the American ports on the West Coast. You go to Vancouver.
Yep.
What's the Canadian rail that runs straight to Chicago now?
Good question. Escapes me.
I forget the name of it. Yeah, but it's just significantly cheaper, even with any potential delays. Right. It was faster and cheaper.
Well, Ken, it's about, I think last time I looked, it was about $900 cheaper. I don't know if it's CN or CP, but it was about $900 per container cheaper. But the other part, though, is if you drew a straight line from northern China to Prince Rupert, it's about a day's sailing shorter than Los Angeles. So it's about 1,200 kilometers, which is significant in terms of tight supply chains this time of the year.
Yeah, I think that leads into a bigger question. I'm talking about do we think most of the Black Friday / last minute shopping stuff is here?
I think it's just arrived. If you follow the recent surge of record level imports that were in last week and this week, I think it's certainly on the docks. A lot of shippers, again, Ari at Journal of Commerce reported that some of this volume was heading to alternate ports away from congestion in Los Angeles and moving around to more, Gulfport, Houston, Savannah, those sorts of ports. So I think it's already on the ocean or at anchor and most likely on the docks right now.
Yeah, so that stuff will likely be in a distribution center or a forward stocking location or a warehouse. In the next week, right? As we head into, I'm not seeing a ton of evidence of strong Black Friday sales. I don't think retailers have to.
Yeah, I mean, at least for me, like there's not really anything I'm super excited about getting for Black Friday this year.
Well, Ken,
Especially
on
the
those,
durable side, right?
right?
Yeah,
Yeah, those volumes in those two big warehouse markets on the West Coast in Stockton and Ontario, those volumes were up 17% last week after heading downwards for the 3 weeks prior. So that volume's certainly starting to move out of those markets right now.
For sure. So with that, I'm going to cut it short. Maybe give viewers a chance to duck out and vote if they can use the time. I'll take care of a couple housekeeping items. So I want to thank everyone for joining this week. It was really great to catch up and talk about the freight markets. Give a shout out. Dr. Chris Kaplis was on with us last week. Wanted to shout out to the Freight Vine podcast. Again, excellent content, comes out every other week with industry luminaries. Like and subscribe to this if you'd like to be notified of any content as we produce it, or any of the recordings that we produce of the live show. We've already covered the market updates and told you where to go on the website. But with that, again, we're given this sort of unprecedented in the history of humanity right to head out and essentially determine our future. So I would encourage all of you, if you haven't already, get out there, let your voice be heard at the ballot box, and we will see you next week. And have a great and safe rest of your week.
Thank you.